Hello, investors. Welcome to monthly interaction with Canara Robeco. It was an eventful month on the global front. There were two or three key events that happened during last month on the global front. First was clearly the escalation between Israel and Iran as an outcome of killing of Hezbollah leader. As we have been saying, we think that this remains a worrying point from the geopolitics perspective, given that it has implications for oil. And as an outcome of this event, clearly you have seen the oil spiking from about less than $70 or around $70 to almost $80 during last month. That was clearly the first event. Second was the US data points incrementally were not as bad as they were expected in terms of growth, while the inflation continues to moderate and core PCA actually came down to approximately 2.5%. The incremental growth data point remain relatively more resilient. The unemployment data remains more resilient, and as an outcome, you have seen that the yield has 10-year GSEC has again crossed 4% from the bottom of 3.6 to 3.7%. That was second event. And lastly, the Chinese market actually doing really well as an outcome of the effective fiscal monetary support, part of which has been given, part of which is expected in the Chinese market. The Chinese market from bottom to bottom is up probably 20 to 25% in probably 2 weeks time or 3 weeks time. That is because the market starting point was really cheap, and there is a hope that there will be sizable movement from government side, both on monetary and fiscal side, as well as actually helping the real estate sector. In terms of our view on this aspect, our view still remains that China is too large economy. There are structural issues around demographics and where the real estate cycle is in terms of leverage. And so it's very unlikely, despite the government intervention, that you are likely to get a structural rebound in this economy. And to that extent, on commodity side, we remain little circumspect from medium term perspective. So those are the three key events clearly. The escalation in the Middle East, the oil prices have gone up as an outcome. We expect this to be around for some time, and you can't actually shrug away possible further escalation between Israel and Iran. Second is, while the US inflation remains on track to towards that 2%, the intermittent growth data points continue to be strong, and as an outcome, your yield has actually strengthened a little bit. 10-year GSEC has strengthened a little bit. And lastly, on China front, in our view, there is a tactical bounce back that is happening in the market. We don't expect this to lead to commodity price increases on a structural basis, given our view on what the challenges are in terms of demographics and real estate in China. That is the global side of the market, which was quite eventful during last month. Coming to domestic side, there were no incremental significant data points. Macro, as we have been saying, that macro remains healthy, balance sheets remain healthy. I think the only incremental challenge or data points that are coming up is there is a slowdown in several segments, particularly on the urban consumption side as well as the investment side. And this is predominantly because the government spending during the first 5-6 months has been lower on a YOY basis. And this is predominantly because first you are in election mode, and then you had basically a heavy monsoon in probably predominant part of the country. That is reflecting in the way intermittent numbers are playing out. Having said that, monsoon has been extremely good. So all in all, the macros remain healthy, external balances remain healthy, the forex remains healthy, inflation is under control, growth rates still remain fairly resilient. The only challenge is intermittent growth slowdown as an outcome of what is happening to urban consumption as well as the investment cycle, because the government capex has been weaker as an outcome of election. So that's on the macro front. Coming to the earnings, we are going into the earnings season. The previews are out from most of the consensus for most of the large institutional research houses, and it is very evident that the earnings growth is likely to be single digit, probably mid single to high single digit, which is what we have been alluding to for last 2 quarters, that for financial year 25, clearly you are likely to see some earnings downgrades rather than upgrades. Last whole year, financial year 24, we had earnings upgrades because the margins were expanding. The top line was 10%, but the margins were expanding and you were getting the earnings upgrade cycle. This year in financial year 25, as the government actually starts pulling back in terms of the capex or moderating the capex, private capex and consumption has to really, and real estate has to really pick up for the earnings upgrade cycle has to happen. while we think that directionally all of these things will happen, intermittently we don't see them happening at the pace at which market is expecting in financial year 25. And that's what is reflecting in the number. Exports is weak, consumption still remains weak, real estate is doing fairly well, but it was the government capex which was driving the earnings upgrade cycle. As the government capex is moderating, the rest of the pillars of the economies have to actually, in a way, pull the earnings up, which we don't see happening intermittently in financial year 25. And that's where already, I think in first half, you will get single digit earnings growth. And as an outcome, you are seeing a little bit of earnings downgrade for financial year 25. First time, probably in 4 years, now you're seeing earnings downgrades in the economy. Having said that, our view still remains contextually a little more circumspect given where the valuation and earnings are, but structurally very, very bullish. And the reason for structurally from next 2 3 5 years 3 years 2 to 3 years perspective to remain bullish are as follows. First, we still remain one of the best growing economy. Our demographics still remain one of the best. The capital efficiency in our country still remains the best. The balance sheets are on the right side of the cycle, and you are likely to get balance sheet expansions over next 2 3 years than compressions. It's only government who has expanded balance sheet as of now. You will see as you go forward, you will see the private capex happening by as private corporates expand their balance sheet. You will see basically household capex happening through real estate, so real estate cycle expanding, and as an outcome eventually you will also see consumption cycle, but this is likely to be a 2 3 year phenomenon. That's where our view still remains that from a structural perspective, earnings consensus which is built at about 12 to 15% should not be a challenge, given that you are in a business cycle, you are in an earnings growth cycle, you are in a real estate cycle, you are in a credit growth cycle. And so from those perspective, we remain very, very constructive, and investors should use any volatility, downside volatility that comes during this year as an outcome of upfrontation of valuation and intermittent earnings slowdown as an opportunity to actually look at their asset allocation and allocate towards equities. So that's how we are looking at market. Lastly, valuations still remain expensive. Large caps are fairly in a fair zone, or probably 5%, 7% expensive than the historical valuations. But as you go into mid cap, small cap, that part of the market still remains expensive. And to that extent, if the earnings growth were to be moderate, you would get good opportunities in that part of the market during this year. That's what our view is at this point in time. This is it from our side for the last month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.